Harshvardhan Dole is with us. He's Senior Vice President, Institutional Equities at IIFL. Harsh, good morning. Great to have you with us here back in the program. And I mean, I guess it's a busy time for you, right? Because everything under your coverage is it's boom time. Well, the markets are doing well, but power, oil companies through the roof. Let's just start with power. So you heard Vivek highlighting some of the takeaways from that Jefferies summit. Just talk to us a little bit about how the mood is changing, what's happening, what investors are doing afresh. Are some of the non-believers turning into converts now? And where is maximum interest in the power space, in the value cycle?
Well, Prashant, thanks for having me. And you aptly said, I think the mood of the market seems to be in the energy space. And more so because of the favorable verdict that the elections have thrown up. So looks like the risk of a knee-jerk reaction in terms of populist measures seem to have dying away. But that said, I think if one assesses the basic fundamentals of the sector, the fundamentals of the sector are turning now more favorable for the industry and going away from the consumers. And the reason why I say this is the demand is fairly strong and the supply is coming in a much more calibrated manner. And I would actually, expect the demand side measures to remain fairly firm. And at the same time, government to be proactive and encourage the industry to increase the supply side. We have seen a great, call from the minister to step up thermal capacity by 80 gigawatt at a time when India is preparing to add 400 gigawatt of renewable energy. So I think the thrust is more on capacity additions. And typically we have seen that whenever there is investment in generation, it necessitates a concomitant investment in transmission as well as distribution. So the whole capex cycle, which was perhaps stuck for some time, is showing signs of revival, which is making almost every stakeholder quite exciting.
So what, according to you, is best placed right now from an investment standpoint? I mean, would you look at, the generators? Would you look at the transmitters? Would you look at people who finance these power players? Would you look at renewable? How should one, look at this space from an investment standpoint? How should one allocate funds?
Well, there is money to be made, in my opinion, in every segment of the sector. Be it somebody who's producing fuel, i.e. somebody like a Coal India, which will actually see meaningful uptake in the coal that they produce. There will also be an opportunity for somebody who's going to generate power because of the massive tailwinds available for them. Somebody who's going to distribute and transmit the power, there's equal opportunity. And at the same time, somebody who's going to offer solutions in the form of smart metering, financing them, there is ample on the table as well. So it's basically an opportunity over the next maybe 5 to 7 years as to pick and choose the revenue model that we like. Frankly, if you ask me...
Go ahead.
So frankly, if you ask me, the way we would like to prefer the theme is by owning some of the companies who have got solid balance sheets and revenue models which allow them to pass on any escalations in the input cost. One should be mindful that the macro is still uncertain. Interest rates are all over the place. Forex is all over the place. So we would like to own, some of these cost plus gencos and cost plus transmission companies.
You've told us what's on the buffet. Tell us what should we take on the plate.
So last week we put out a note saying that the valuations are no longer distressed. But if one were to do a reverse DCF, what the market seems to be pricing in is maybe a single-digit free cash flow growth for companies like NTPC, Torrent Power, CESC. And that's what we like. We like the revenue models a lot. Perhaps one can be a bit mindful in terms of entering into these stocks, but their broader revenue models are pretty much intact. And that's what we continue to like.
And I think last time we were on, you had mentioned before the rally in CESCs began, or around just the time it was taking off, I think you had CESC as a pick. So it's not done very much for the last couple of years, but it's been good so far now. Got it. You still think there's money to be made in Coal India? I mean, after the 60% move this year?
I think there's money to be made, in my opinion, for two reasons. One is the volume they continue to surprise in terms of growth, and secondly, the pricing continues to be favorable, for which the
Okay.
free cash generation and the dividend yield is fairly attractive. So we continue to like Coal India as an asset class.
All right, Harsh, very quickly, we just got a few seconds before market opens. But what about OMCs? You have been positive. They've just taken off. Rocket on those stocks out there. Have they overdone themselves, or is there more to be made?
Yes, I think from a valuation perspective, they're still cheap, but the momentum seems to be fairly strong. I think every dip, every correction in these stocks is a great entry point.
Wow, that's quite something. Thanks very much, Harsh. Good speaking with you, and it's a pleasure having you with us here on CNBC-TV18. Dips are a buying opportunity in OMCs. Stocks, I mean, P multiples are still single digit, and that's in a market where, P multiples of 30, 40, etc. are quite regular out there. So just a